Welcome to our comprehensive guide on cash flow forecasting. In today's fast-paced business world, understanding your cash flow is more important than ever. Cash flow forecasting helps you anticipate the movement of money in and out of your business, ensuring you have enough funds to cover expenses and seize new opportunities. Whether you're a small business owner or managing a large enterprise, mastering cash flow forecasting can be the key to long-term financial stability and growth. Let's dive in and explore why cash flow forecasting is essential for every business. Cash flow refers to the total amount of money being transferred into and out of your business. It's a measure of your company's liquidity and its ability to meet short-term obligations. Positive cash flow means you have more money coming in than going out, while negative cash flow can signal potential trouble. By keeping a close eye on your cash flow, you can make informed decisions and avoid unexpected financial challenges. Understanding this concept is the foundation for effective forecasting. Forecasting cash flow allows you to predict future financial positions and plan accordingly. By estimating your income and expenses, you can identify potential shortfalls before they become critical. This proactive approach helps you avoid late payments, missed opportunities, and even insolvency. With a reliable forecast, you can confidently make strategic decisions, such as investing in new projects or hiring additional staff, knowing your business will remain financially healthy. There are several types of cash flow forecasts, each serving a different purpose. Short-term forecasts typically cover a few weeks to a few months and help manage day-to-day operations. Medium-term forecasts span several months to a year, supporting budgeting and planning. Long-term forecasts look several years ahead, guiding major investments and strategic decisions. Choosing the right forecast type depends on your business needs and goals. Cash flow forecasting can be done using direct or indirect methods. The direct method involves tracking actual cash receipts and payments, making it ideal for short-term forecasts. The indirect method starts with net income and adjusts for non-cash items, making it suitable for longer-term projections. Understanding the differences between these methods helps you choose the best approach for your business and ensures accurate forecasting. Solid cash flow forecast includes several key components: projected cash inflows, projected cash outflows, and the opening and closing cash balances. Inflows might include sales revenue, loan proceeds, or investment income. Outflows cover expenses like rent, payroll, and supplier payments. By accurately estimating these components, you can create a reliable forecast that supports sound financial management. Build an accurate cash flow forecast. Start by gathering all relevant financial data. This includes historical sales figures, expense reports, accounts receivable, and accounts payable. The more detailed and accurate your data, the more reliable your forecast will be. Don't forget to consider seasonal trends, upcoming projects, and any known changes in your business environment. Projecting cash inflows involves estimating all sources of incoming cash for your business. This typically includes sales revenue, but may also involve loans, grants, or investment income. Use historical data as a guide, but adjust for any expected changes, such as new products, market trends, or economic conditions. Accurate inflow projections are crucial for a realistic cash flow forecast. Estimating cash outflows means identifying all expenses your business will incur. This includes fixed costs like rent and salaries, as well as variable costs such as inventory purchases and utilities. Don't overlook irregular expenses like equipment repairs or annual fees. By carefully listing all expected outflows, you can avoid unpleasant surprises and keep your forecast accurate. Once you've projected your inflows and outflows, calculating net cash flow is straightforward. Simply subtract total outflows from total inflows for each period. A positive net cash flow means your business is generating more cash than it's spending, while a negative figure signals a potential cash crunch. Monitoring net cash flow regularly helps you stay on top of your finances. The opening cash balance is the amount of cash your business has at the start of the forecasting period. It's a crucial starting point for your forecast, as it affects your ability to cover expenses and invest in growth. Make sure your opening balance is accurate by reconciling it with your latest bank statements and accounting records. Closing cash balance is the amount of cash you expect to have at the end of each period. It's calculated by adding net cash flow to the opening balance. Tracking closing balances over time helps you spot trends, anticipate cash shortages, and plan for future investments. This ongoing process is vital for maintaining financial health. Many businesses use spreadsheets to create and manage cash flow forecasts. Spreadsheets offer flexibility and allow you to customize your forecast to fit your unique needs. You can easily update figures, run different scenarios, and visualize trends. However, be sure to double-check your formulas and data entries to avoid errors that could impact your forecast. In addition to spreadsheets, there are specialized cash flow forecasting software solutions available. These tools can automate data collection, provide real-time insights, and generate detailed reports. Using software can save time, reduce errors, and help you make more informed decisions. Evaluate different options to find the best fit for your business size and industry. Scenario planning involves creating multiple cash flow forecasts based on different assumptions. For example, you might model best case, worst case, and most likely scenarios. This approach helps you prepare for uncertainties and make contingency plans. By understanding how changes in sales, expenses, or market conditions affect your cash flow, you can respond quickly to new challenges. Cash flow forecast is not a one-time task. Regularly monitoring and updating your forecast ensures it remains accurate and relevant. Review your actual results against your projections, identify any variances, and adjust your forecast as needed. This ongoing process helps you stay proactive and maintain control over your finances. Even experienced business owners can make mistakes when forecasting cash flow. Common errors include overestimating sales, underestimating expenses, and failing to account for seasonal fluctuations. Avoid these pitfalls by using realistic assumptions, double-checking your data, and regularly reviewing your forecast. Learning from mistakes helps you improve your forecasting skills over time. Uncertainty is a fact of business life. Unexpected events like economic downturns, supply chain disruptions, or sudden expenses can impact your cash flow. By building flexibility into your forecast and maintaining a cash reserve, you can weather these storms. Scenario planning and regular updates also help you adapt quickly to changing circumstances. Timing is critical in cash flow forecasting. Knowing when cash will be received and when payments are due helps you avoid shortfalls. For example, a large sale might boost your revenue, but if payment is delayed, you could still face a cash crunch. Accurate timing ensures your forecast reflects reality and supports better decision-making. It's important to understand the difference between cash flow and profit. Profit is the money left after all expenses are paid, while cash flow tracks the actual movement of cash. A profitable business can still run into cash flow problems if payments are delayed or expenses are mistimed. Always monitor both metrics to ensure financial health. Efficiently managing accounts receivable is key to maintaining healthy cash flow. Set clear payment terms, follow up on overdue invoices, and consider offering discounts for early payments. By speeding up collections, you ensure more cash is available to cover expenses and invest in growth opportunities. Managing your accounts payable is just as important as receivables. Negotiate favorable payment terms with suppliers, schedule payments to optimize cash flow, and avoid late fees. By carefully controlling outflows, you can maintain a positive cash position and strengthen supplier relationships. If your business is seasonal, cash flow forecasting becomes even more critical. Plan for periods of low revenue by building up reserves during peak times, adjust your forecast to reflect seasonal trends, and be prepared to manage expenses carefully during slower months. This proactive approach helps you stay afloat year-round. Planning for growth or expansion, cash flow forecasting helps you determine if you have the resources to support new initiatives. Factor in additional expenses, potential delays in revenue, and the need for extra working capital. A detailed forecast ensures your growth plans are financially sustainable. Sometimes, even the best-managed businesses need extra cash. Cash flow forecasting can help you identify when you'll need financing and how much to borrow. Explore options like lines of credit, loans, or investor funding. By planning ahead, you can secure the best terms and avoid last-minute financial stress. Clear cash flow forecasts are valuable tools for communicating with stakeholders, such as investors, lenders, and employees. Transparent forecasts build trust and demonstrate your commitment to sound financial management. Use visual aids like charts and graphs to make your forecasts easy to understand and actionable. Don't forget to factor in legal and tax obligations when forecasting cash flow. Taxes, regulatory fees, and compliance costs can significantly impact your cash position. Stay informed about upcoming deadlines and set aside funds to meet these obligations. This helps you avoid penalties and maintain good standing with authorities. Regularly reviewing your cash flow forecast helps you identify areas for improvement. Look for patterns in your data, such as recurring shortfalls or unexpected surpluses. Use these insights to refine your forecasting process and make better financial decisions in the future. Continuous improvement is key to long-term success. Startups face unique cash flow challenges, often dealing with limited resources and unpredictable revenue. Accurate forecasting is essential for survival and growth. Focus on realistic assumptions, monitor your burn rate, and be prepared to pivot as needed. A strong cash flow forecast can help you attract investors and build a sustainable business. In summary, cash flow forecasting is a vital tool for managing your business's finances. By understanding your inflows and outflows, planning for uncertainties, and regularly updating your forecast, you can ensure financial stability and support growth. Start building your cash flow forecast today and take control of your business's financial future.